Hello, my friends. Today we're going to talk about the metrics you need to track for your business to ensure this growth. This will be part one of a three-part series where I'll focus on marketing, sales, and customer success metrics. And conveniently, these categories align with each hub in your HubSpot portal. So if you're using HubSpot, you'll want to pay extra attention. But this being part one, let's focus on my favorite marketing metrics. So let's get into it. First, cost per lead, CPL, cost per acquisition, CPA. Your cost per lead is the amount of money it takes to generate a new prospective customer, aka lead, for your sales team from a current marketing campaign. So these prospective customers, they've seen an ad, they've clicked on it, then they've given some of their contact details in exchange for a lead magnet or more information about your product. This helps keep your pipeline full. CPL lets marketing teams know if they're spending an appropriate amount of time on different avenues of acquiring new leads, such as Google ads or Facebook ads, but this can also translate to other investments like events or outside agencies that are doing lead gen or any other marketing service for you. The higher the CPL compared to other businesses in your industry, the less effective the marketing campaign is. So naturally, a lower CPL is considered ideal. All right, number two. Return on ad spend, or ROAS. ROAS measures the efficacy of a digital advertising campaign. ROAS helps online businesses evaluate which methods are working and how they can improve future advertising efforts. If you're an e-com or any productized service, this is especially important for you. I'll show you the calculation by way of example. So say a company spends $2,000 on an online advertising campaign in a single month. In this month, the campaign results in revenue of $10,000. Therefore, the ROAS is a ratio of 5-to-1 or 500% because $10,000 divided by $2,000 is $5. So for every dollar the campaign spends, or the company spends on its advertising campaign, it generates $5 worth of revenue. So to calculate what it truly costs to run an advertising campaign, you cannot forget these three factors. One, your partner or vendor costs. These are common fees and commissions associated with partners or vendors that assist on the campaign or channel level. An accurate accounting of in-house advertising expenses such as salary or other related costs must be accounted for. If these factors are not accurately quantified, ROAS just won't explain the efficacy of individual marketing efforts, and its utility as a metric for your business will decline over time. Second, affiliate commission. This is simple. It's just the percent commission paid to affiliates as well as any network transaction fees or things like that. And third, clicks and impressions. Metrics such as average cost per click, total number of clicks, average cost per 1,000 impressions, and the number of impressions actually purchased. These are all things that will factor in as you continue to calculate ROAS. And so there's no right answer for what a good ROAS is. It all depends on your business and your overall profit margin. For some companies, a 10-to-1 ROAS is great and what they need to remain profitable, but for other businesses, 2-to-1 or 3-to-1 can be okay. Third, marketing qualified leads. A marketing qualified lead, or an MQL, is a potential customer that has been reviewed by the marketing team and satisfies the criteria necessary to be passed along to the sales team. Your marketing and sales team should be 100% aligned in what a good lead initially looks like. So they may have to fit your ICP or your ideal customer profile or get pretty close to it. And two, they should engage with your business or marketing content so you can collect their information and route them to the proper salesperson. Someone may fit your ICP and visit your website, but they're not necessarily considered an MQL. But if they download an ebook or a case study, that is now verifiable information that they are aware of your business and potentially interested in buying from you. So there's a lot of debate around the importance of MQLs, especially in larger B2B organizations that have complex offerings or deal processes. I'll just save that for another video. 4, click-through rate. A click-through rate, or CTR, is the ratio of clicks to impressions on an ad campaign, landing page, email, or really anything a lead can view and then click through on. CTRs are calculated by taking the number of clicks divided by the overall impressions and then expressing that result as a percentage. So if a company runs an ad campaign that generates 10,000 impressions and 500 people click through to the landing page, that campaign has a CTR of 5%. CTR is a fantastic metric to compare performance across different ad sets, different creatives, landing page layouts, email body content, and more. Overall, I like to really think of it as a metric of how engaging your content is and how aligned it is with your target market. Number 5, lead score. Lead scoring is the process of ranking the sales readiness of a lead using a predetermined methodology. The process essentially goes like this. You determine which criteria or data points indicate a sales qualified lead, and then assign point values to each of those criteria, ultimately leaving you with a final score for each lead. So a lead scoring system allows you to take the subjectivity out of the process, and you can truly understand which leads have the best chance of converting. So some items you may want to include in your lead scoring are they may have viewed a high value page on your website, like a pricing page, for example, or their alignment with your ideal customer profile. So for example, you may assign 50 points if someone is an exact fit, or you may assign 25 points if they're an okay fit. And third, their alignment with your ideal account profile. So if you target B2B companies doing $10 million in revenue or more, you might have a higher score for companies that are doing more in revenue or might have more employees. The biggest value of lead scoring is allowing sales to prioritize who they should reach out to first. It helps get marketing and sales aligned, and it helps you close deals much faster. 6, your lifetime value, or LTV. LTV is a prediction of the net profit attributed to an ongoing relationship between the client and your business. By providing a running estimate on how much a particular client is likely to spend with you, LTV helps set marketing budgets and ensures that companies pursue the most effective users. If a company can predict a user's lifetime value successfully, it provides marketers with a much better base on which to make decisions, helping a company maximize the effectiveness of its advertising spending or overall marketing spending. It doesn't have to be ads. The term itself, it's also known as customer lifetime value, or CLTV, and lifetime customer value, LCV. A lot of those terms just they're interchangeable. So if your average LTV is $10,000, you are likely much more comfortable to spend $2,000 or $3,000 to acquire that customer because you know you're likely to get a 3 or 4x return on them. And so that's all for marketing metrics. Be sure to watch part 2 where I'll cover the sales metrics to know and track for your business. And finally, please like and subscribe to get more marketing, CRM, and business advice from me. Thank you for watching. I'll see you on the next one.